There's a famous story about the tulip bubble in 1637, Holland. At the peak, a single bulb sold for more than a luxury house in Amsterdam. Everyone knew tulips were just flowers. But the fear of missing out was stronger than the fear of looking stupid. The bubble didn't pop because people suddenly realized tulips couldn't cure diseases or grant immortality. It popped because one day someone tried to sell and nobody wanted to buy. Right now, in January 2026, we're watching something similar, except instead of tulips, it's chatbots. And instead of Amsterdam merchants, it's the richest companies in human history betting $7 trillion that if they just burn enough cash, physics and mathematics will bend in their favor. In January 2025, Sam Altman just told the world that OpenAI loses money on every single ChatGPT Pro subscriber. Not a little money, not break-even with future upside. They are underwater on their flagship product, the thing they charge $200 a month for, the premium tier that's supposed to prove this whole thing works. And Wall Street didn't panic. They didn't pull funding. They doubled down. This is the story of how we went from a parlor trick that writes poems about your cat to a $7 trillion infrastructure bet in 24 months. And why the smartest people in Silicon Valley are now trapped in a poker game where folding means death and staying in means lighting your future on fire. Let's start with something simple. How much does it cost to run a business? If you're selling lemonade, you need lemons, sugar, water, cups. Let's say all of that costs you 50 cents per cup. You sell the lemonade for $2. You pocket $1.50. That's profit. That's how business works. You make something, you sell it for more than it costs, and you use that margin to grow, hire people, and eventually build an empire of lemonade stands. OpenAI doesn't do that. In 2025, Sam Altman tweeted something that should have been a scandal but was treated like performance art. He said OpenAI is losing money on pro subscribers. These are people paying $200 a month, 10 times what a Netflix subscription costs, and OpenAI is still in the red on every single one of them. Let that sit for a second. This isn't a new startup testing pricing. This is a company with a $150 billion valuation. This is the flagship product of the most hyped technology since the iPhone. And they're selling it at a loss? How did they even pick the 20 price for ChatGPT Plus in the first place? Market research? Cost analysis? A spreadsheet model showing path to profitability? No. They tested $20.42 and asked people which one made them less angry. They picked a $20 because the vibes felt better. I'm not joking, that's the actual story. A company now worth more than Goldman Sachs priced its product based on vibes. The result? In 2024, OpenAI brought in $307 billion in revenue. That sounds impressive until you learn they lost $5 billion. They didn't just fail to turn a profit. They lost more money than they made. It's like running a lemonade stand where you sell 1,000 cups, collect $2,000, and somehow end up $3,000 in debt. Now, you might be thinking this is temporary. Maybe they're spending big now to dominate later. That's a fair instinct. Amazon did that. They ran at a loss for years, undercut competitors, and eventually became the everything store. But here's the difference. Amazon's path to profitability was clear. Sell books cheaper, add more products, scale logistics, and eventually the volume makes up for the margins. You could draw the line from A to B. OpenAI's plan is different. It's not a line. It's a hockey stick. Picture a graph. For the first few years, it's almost flat. Growth is slow, steady, maybe a little disappointing. Then suddenly, without warning, the line rockets vertical. Revenue explodes. Costs flatten. Profits go parabolic. That's the hockey stick. Every pitch deck in Silicon Valley has one. Most of them are fantasy. Sam Altman's hockey stick is particularly aggressive. In 2024, OpenAI made $7 billion. He's projecting $20 billion in 2025. That's aggressive but possible if adoption keeps accelerating. But then look at 2029. He's projecting $100 billion, not $30 billion, not $50 billion, $100 billion in revenue in 4 years. To put that in context, it took Google 16 years to hit $100 billion. It took Amazon 14 years. OpenAI wants to do it in 7, starting from a product that loses money per user. When investors asked how this math works, Sam didn't flinch. He said the hockey stick is real. The technology will improve, costs will drop, demand will explode. And to make it happen, they just need $115 billion in cash, not profit. Cash, raw liquidity to burn through while they wait for the magic to kick in. So where does $115 billion come from? Microsoft's already in for $14 billion. SoftBank just threw in $500 million. Sam's now courting Saudi Arabia, the UAE, and any sovereign wealth fund with more money than patience. The pitch is simple. In 5 years, we'll be printing money faster than the Federal Reserve. But here's the uncomfortable part. To justify OpenAI's current valuation, let alone the hockey stick projection, the AI industry as a whole needs to generate $2 trillion in annual revenue by 2030, not $200 billion, which is roughly where it is now. $2 trillion, that's a tenfold increase in 5 years. For context, the entire global semiconductor industry makes about $600 billion a year. The entire video game industry makes $200 billion. Sam Altman is betting that AI will become bigger than both combined in half a decade. And he's not alone. Google, Microsoft, Meta, Amazon, and Apple are collectively spending $350 billion on AI infrastructure. Not over 5 years. In 1 year, they're building data centers the size of small cities. They're buying GPUs so fast that NVIDIA can't keep up with demand. Think of big tech like a poker table. Everyone's sitting there with unlimited chips. Microsoft bets big on OpenAI. Google panics and bets big on Gemini. Meta sees both of them betting and throws money at Llama. Amazon looks around, sees everyone else going all in, and decides they can't afford to sit out. Nobody folds. Because if you fold and AI turns out to be the next internet, you're dead. You become the next BlackBerry. You become the cautionary tale that business schools teach for the next 30 years. This is the prisoner's dilemma at civilizational scale. Cooperation would be rational. They could all slow down, figure out what actually works, and build sustainably. But cooperation means risking extinction. So everyone defects, everyone floods the zone, everyone prays they're the one holding the winning hand when the cards get flipped. And that brings us to the part nobody wants to say out loud. What if the cards are bad? I don't mean AI is useless. Obviously it's not. ChatGPT writes essays, Midjourney makes art, Codex helps programmers. These are real capabilities. But capabilities don't automatically translate to $2 trillion in revenue. The Segway was a real capability. It didn't revolutionize transportation. 3D printing was a real capability. It didn't replace manufacturing. The gap between this is cool and this is worth $7 trillion is where bubbles live. Right now, the AI hype is being funded by companies that are too big to fail and too rich to care. Microsoft has $80 billion in cash. Google has $110 billion. These companies can burn money for years without flinching. But that doesn't mean they will. History is full of technologies that looked revolutionary until the bills came due. In the late 1990s, fiber optic companies laid thousands of miles of cable across the ocean floor, convinced the internet would need infinite bandwidth. They were right about the internet. They were wrong about the timeline. Most of those companies went bankrupt. The infrastructure got bought for pennies on the dollar. The dot-com bubble didn't pop because websites were stupid. It popped because capital dried up. Interest rates rose. Investors wanted profits, not promises. And suddenly, companies that were valued at billions disappeared overnight. We're not there yet. But the cracks are showing. AI told a user to put glue on pizza to make the cheese stick better. Another one cited legal cases that don't exist. A lawyer used ChatGPT to draft a brief, submitted it to court, and got sanctioned because half the precedents were hallucinations. These aren't edge cases. These are warning signs that the technology isn't as reliable as the valuations assume. And then there's the cost problem. Training GPT-4 allegedly cost $100 million. Training GPT-5 will cost significantly more. And that's just training. Running inference, the actual act of answering user questions, is staggeringly expensive. Every time you ask ChatGPT a question, OpenAI pays for compute. The more people use it, the more it costs. Scale doesn't make this cheaper. It makes it worse. This is the opposite of a normal tech business. Facebook got cheaper per user as it scaled. AWS got cheaper per transaction as it scaled. AI gets more expensive as it scales because the models are doing more work, not less. Sam Altman's bet is that this changes. That future models will be so efficient, so optimized, that costs collapse and margins explode. Maybe he's right, but maybe he's not. And if he's not, the entire industry is building on sand. Let me give you an analogy. Imagine you're building a rocket to Mars. You know it's expensive. You know it's risky. But you believe that once you get there, you'll find something valuable. Minerals, technology, alien artifacts, whatever. So you raise billions of dollars, build the rocket, and launch. Halfway to Mars, you realize the rocket is heavier than you thought. It's burning fuel faster than projected. You're not sure you'll make it, but you're already in space. Turning back means admitting failure. So you keep going. You burn the reserve fuel. You jettison non-essential systems. You pray that when you land, there's actually something worth the trip. That's where we are with AI. We're halfway to Mars, burning fuel we're not sure we have, betting on a payoff we haven't confirmed exists. And the people holding the matches? They're not stupid. They're not delusional. They're rational actors in an irrational game. Because in their world, the risk of being wrong is smaller than the risk of being left behind. Sam Altman isn't losing money on purpose because he enjoys it. He's losing money because the alternative is losing the war. If OpenAI slows down, Google wins. If Google slows down, Microsoft wins. If everyone slows down, some startup in a garage with a new architecture eats everyone's lunch. This is the Red Queen's race. You have to run as fast as you can just to stay in place. And if you want to get ahead, you have to run faster than that. But here's the thing about Red Queen's races. Eventually, someone collapses. The dot-com bubble burst in 2000. The housing bubble burst in 2008. The crypto bubble deflated in 2022. Every time, the warning signs were there. Every time, people said, this time is different. And every time, math won. Right now, AI feels different because the companies involved are too big to fail. But that's what people said about Lehman Brothers. I'm not predicting a crash tomorrow. I'm not saying AI is worthless. I'm saying we're in the inhale before the scream. The moment where everyone's holding their breath, hoping the bet pays off, knowing that if it doesn't, the fallout will be biblical. And the uncomfortable truth is this: the people making these bets don't need to be right forever. They just need to be right long enough to cash out. Sam Altman, Satya Nadella, Sundar Pichai, they're not betting their own money. They're betting other people's money. Shareholders, pension funds, sovereign wealth funds. If the hockey stick materializes, they're heroes. If it doesn't, they'll pivot, restructure, and move on to the next big thing. The rest of us, we get to watch, because this isn't just about ChatGPT or Google Bard or Meta's Llama. This is about whether we've reached a point where hype is more valuable than reality, where vibes matter more than math, where the fear of missing out is strong enough to override every rational instinct we have. In 1637, someone in Amsterdam held a tulip bulb worth more than a house and wondered if maybe, just maybe, this was insane. But they didn't sell. Because what if tulips really were the future? In 2026, someone at Microsoft is looking at a $14 billion check made out to OpenAI and wondering the same thing. The difference is, we're all watching this time. And unlike tulips, we can't just plant a new bulb and start over. So here's the question I'll leave you with. When the music stops and someone finally tries to sell, will anyone be left to buy?